I'll never forget opening that envelope from the IRS. Inside was a bill for $837, an underpayment penalty I didn't even know existed. I'd been freelancing for 18 months, filing my annual tax return like clockwork, paying what I owed. But apparently, that wasn't enough. The IRS expected me to pay throughout the year, not just in April. That penalty was my introduction to quarterly estimated taxes, and honestly, it made me furious. Why didn't anyone tell me about this? Here's what I learned the hard way. The US tax system operates on a pay-as-you-go basis. That means the government expects to receive your tax money throughout the year, not in one lump sum when you file. If you're an employee with a W-2 job, this happens automatically through paycheck withholding. Your employer takes out taxes before you even see your paycheck. But if you're self-employed, a freelancer, a contractor, or have significant income outside of wages, you're responsible for sending in those payments yourself. 4 times a year. Every year. So who needs to make quarterly estimated tax payments? The general rule is simple. If you expect to owe at least $1,000 in federal tax after subtracting withholding and credits, you're supposed to pay quarterly. This typically includes freelancers, independent contractors, sole proprietors, partners and partnerships, and S-corporation shareholders. It also applies to anyone with substantial income from investments, rental properties, or side gigs. Even retirees with large retirement account withdrawals might need to pay quarterly. The key question is, will taxes be withheld from this income? If not, you probably need to estimate. Quarterly estimated taxes aren't actually paid every 3 months, which confused me at first. The IRS divides the year into 4 unequal payment periods. The first payment covers January through March and is due April 15th. The second covers April through May and is due June 15th. The third covers June through August and is due September 15th. And the fourth covers September through December and is due January 15th of the following year. Notice that second period is only 2 months? Yeah, I don't know why either. Just memorize the 15th of April, June, September, and January. When I finally decided to start paying quarterly taxes, I made a huge mistake. I looked at my previous year's total tax bill, divided it by 4, and sent that amount to the IRS each quarter. Seemed logical, right? Wrong. That year, my income increased by about 40%. When tax time came, I still owed a massive amount because I'd underpaid all year. I also got hit with another penalty. That's when I learned that estimated taxes are supposed to estimate your current year's income, not just repeat last year's numbers. The calculation is more nuanced than simple division. After my second penalty, I discovered something called the safe harbor rule, and it changed everything. This rule protects you from underpayment penalties even if you end up owing money in April. Here's how it works. If your quarterly payments total at least 90% of your current year's actual tax liability, you're safe. Alternatively, if your payments equal 100% of your previous year's total tax, you're also safe. There's one catch. If your income is over $150,000, that second threshold jumps to 110% of the prior year. The safe harbor rule became my security blanket. Let me walk you through the actual calculation, step by step. First, estimate your adjusted gross income for the year. Include all your income sources, freelance earnings, investment income, rental income, everything. Second, subtract your deductions, either the standard deduction or itemized deductions, whichever is higher. Third, apply the appropriate tax rate to that taxable income using the current year's tax brackets. Fourth, add self-employment tax if applicable, which is roughly 15% of your net self-employment income. Fifth, subtract any credits you expect to claim. The final number is your estimated annual tax. Divide by 4 for your quarterly payment. Here's something that shocked me. Self-employment tax is separate from income tax. When you're an employee, your employer pays half of your Social Security and Medicare taxes. When you're self-employed, you pay both halves yourself. That's why self-employment tax is roughly 15.3% of your net earnings. This is in addition to your regular income tax. So if you're in the 22% income tax bracket, you're actually paying closer to 37% total on your self-employment income. This was the biggest surprise in my entire tax education. It's also why quarterly payments are so much higher than beginners expect. The IRS provides a form specifically designed to help calculate quarterly estimated taxes, Form 1040-ES. It's not a form you file, it's a worksheet you use to calculate your payment. The form includes a detailed worksheet that walks you through every step of the calculation I just described. It also includes payment vouchers you can mail with a check if you're paying by mail. Honestly, the first time I saw Form 1040-ES, it looked terrifying. But once I worked through it slowly, line by line, it actually made sense. I recommend every self-employed person download it and keep it handy. It's updated every year to reflect new tax brackets and rules. A lot of people think you must make 4 equal payments throughout the year. That's actually not true. The IRS only cares that you've paid enough by each deadline to cover the income you earn during that period. If you earn most of your money in the fourth quarter, you can make a huge January payment and tiny payments the rest of the year. Conversely, if your income is front-loaded, you might pay more early and less later. This flexibility is incredibly useful for people with seasonal income or irregular cash flow. The key is tracking your actual income as the year progresses and adjusting accordingly. For people with wildly uneven income, there's an advanced technique called the annualized income installment method. Instead of assuming your income is evenly distributed across the year, this method lets you calculate each quarterly payment based on your actual year-to-date income. So if you earned 90% of your annual income in the first quarter, you'd make a large first payment and smaller subsequent ones. This prevents overpayment and maximizes your cash flow. The downside? It requires filing Form 2210 with your tax return and significantly more record keeping. I use this method now, and it saved me thousands in unnecessary estimated payments. You have several options for actually sending your payment to the IRS. The old-school method is mailing a check with a payment voucher from Form 1040-ES. It works, but it's slow and there's no instant confirmation. The modern way is IRS Direct Pay, a free online system where you pay directly from your bank account. You get immediate confirmation and a payment confirmation number. You can also pay by debit card, credit card, or electronic funds withdrawal, though most card payments involve fees of about 2%. I use Direct Pay for every quarterly payment now. It takes about 5 minutes, and I can schedule payments in advance so I never miss a deadline. Let's say you miss a quarterly deadline. Don't panic, and definitely don't ignore it. The IRS calculates underpayment penalties based on how much you underpaid and for how long. The penalty is basically interest on the unpaid amount. The current rate fluctuates quarterly but is usually around 7 to 8% annually. If you miss the April payment but make it up in June, you'll only owe a penalty for those 2 months. The penalty is calculated when you file your annual return using Form 2210. The best move if you miss a deadline is to make the payment as soon as possible to minimize the penalty. Every day counts. Here's something I wish someone had told me earlier. Most states with income tax also require quarterly estimated payments. The rules vary by state, but they generally mirror the federal system. You'll have separate deadlines, separate calculations, and separate payment portals. Some states use the same deadlines as the IRS, but others don't. For example, some states require payments on the last day of the month rather than the 15th. When I started paying federal estimated taxes, I completely forgot about state taxes and got penalized there too. Now I always check both federal and state requirements and make both payments every quarter. It doubles the administrative work but keeps me compliant. There's a psychological trap many self-employed people fall into, and I definitely experienced it. When you receive payment for your work, the full amount hits your bank account. There's no line item showing taxes withheld. That money feels like yours to spend. But roughly 25 to 40% of it actually belongs to the government. If you spend it all, you'll be scrambling when the quarterly deadline arrives. I learned to immediately transfer my estimated tax percentage into a separate savings account the moment I received any payment. Treating that money as already gone was the mindset shift that saved me from cash flow disasters. Is it possible to overpay your estimated taxes? Absolutely. If your payments throughout the year exceed your actual tax liability, you'll get a refund when you file your return. Some people intentionally overpay as a forced savings mechanism. Others prefer to underpay slightly and owe a small amount, maximizing their cash on hand throughout the year. I used to overpay because I was terrified of penalties. Now I aim for exactly 100% of my prior year's tax using the safe harbor rule. That way I'm protected from penalties, but I'm not giving the government an interest-free loan. It's all about your personal risk tolerance and cash flow needs. Your income might change dramatically during the year. Maybe you land a huge contract in August or lose a major client in October. The beautiful thing about estimated taxes is you can adjust your payments at any time. If your income shoots up, increase your remaining quarterly payments to avoid underpayment. If your income drops, reduce your future payments to preserve cash. The IRS doesn't lock you into your first quarter's payment amount. I check my actual year-to-date income before every quarterly deadline and recalculate my payment based on current reality, not January's predictions. This adaptive approach keeps me accurate and avoids both penalties and overpayment. Accurate estimated tax payments require accurate income tracking. I keep a simple spreadsheet that tracks every payment I receive, every deductible expense, and my net income. Every month, I update it. Before each quarterly deadline, I know exactly where I stand. This spreadsheet is also invaluable when tax season arrives because all my information is organized and categorized. I also keep digital copies of every estimated tax payment confirmation. If the IRS ever questions whether I paid, I have proof. Good record keeping isn't glamorous, but it's the foundation of stress-free quarterly estimated taxes. 15 minutes of tracking per week saves hours of panic later. Deductions dramatically impact your estimated tax calculation. The more legitimate business expenses you have, the lower your taxable income, and the smaller your quarterly payments. Common deductions for self-employed people include home office expenses, business supplies, professional development, software subscriptions, travel, meals with clients, health insurance premiums, and retirement contributions. I was leaving thousands on the table my first year because I didn't understand what I could deduct. Now I track every possible business expense meticulously. When calculating quarterly taxes, I estimate my deductions conservatively and factor them into my taxable income. This significantly reduces my payment amounts while staying completely legal and ethical. Here's a powerful strategy one learned. Retirement contributions can reduce your estimated tax burden. If you contribute to a SEP IRA, solo 401k, or traditional IRA, those contributions are typically tax deductible. For self-employed people, you can contribute up to 25% of your net self-employment income to a SEP IRA or up to $66,000 to a solo 401k, depending on income. These contributions lower your taxable income for the year. I now make quarterly retirement contributions timed with my estimated tax payments. It feels good knowing I'm simultaneously paying my tax obligation and building long-term wealth. The tax savings from retirement contributions often surprise people with how substantial they can be. If you're married and your spouse has a W-2 job, there's a clever workaround to estimated taxes. Your spouse can adjust their W-4 withholding to have extra tax withheld from their paycheck. That withholding counts toward your household's total tax liability, potentially covering your self-employment tax obligations without making quarterly payments. The IRS views withholding as paid evenly throughout the year, even if it's increased late in the year. This strategy helped a friend avoid quarterly payments entirely. Her husband increased his withholding to cover both their tax liabilities. It simplified their finances dramatically. Of course, this only works if the W-2 income is high enough to support increased withholding. There's good news for people in their first year of self-employment. You likely don't need to make estimated payments. If you had no tax liability in the prior year and you were a U.S. citizen or resident for the whole year, you're exempt from estimated tax requirements for the current year. This gives new freelancers and entrepreneurs breathing room to establish their businesses without immediately dealing with quarterly taxes. However, you'll still owe the full amount when you file your annual return, so saving throughout the year is still crucial. This exception only applies to the first year. Starting year 2, you're on the hook for quarterly payments like everyone else. Technology has made estimated taxes much easier than when I started. Apps like QuickBooks Self-Employed, FreshBooks, and Keep a Tax automatically track income and expenses, then estimate your quarterly tax obligation. Some even remind you of deadlines and link directly to payment portals. I personally use QuickBooks Self-Employed, and it's been a game changer. It categorizes transactions, calculates my tax burden in real time, and estimates what I should set aside. For about $15 per month, it saves me hours of spreadsheet work. If you're serious about self-employment, investing in good tax software is non-negotiable. The time saved and accuracy gained far exceed the cost. At what point should you hire a tax professional? If your self-employment income exceeds $50,000 annually, if you have multiple income streams, if you're claiming complex deductions, or if you simply feel overwhelmed, it's time to consult a CPA or enrolled agent. A good tax professional costs between $300 and $1,000 for annual tax prep, plus potentially more for quarterly advice. That sounds expensive until you realize they often find deductions and strategies that save far more than their fee. I hired a CPA in my third year of self-employment, and she saved me over $4,000 the first year through deductions I didn't know existed. She also handles all my estimated tax calculations now. Let's talk about something rarely discussed: the psychological burden of managing your own taxes. When you're an employee, taxes happen invisibly. When you're self-employed, you're constantly aware of your tax obligation. Every payment you receive comes with mental math about what you owe. Every business expense is a potential deduction to track. 4 times a year, you send thousands of dollars to the government. It's stressful, especially early on. I went through periods of genuine anxiety about whether I was calculating correctly. The fear of penalties and audits was real. Over time, as my system improved and confidence grew, that anxiety faded. But acknowledging the emotional challenge is important. You're not weak for finding this hard. Let me walk you through my current quarterly routine, refined over years of trial and error. 2 weeks before each deadline, I open my income tracking spreadsheet and review year-to-date numbers. I calculate my total income, subtract business expenses, and estimate my taxable income. I apply current tax rates and add self-employment tax. I compare this to what I've already paid and determine if I need to adjust my payment. I then use IRS Direct Pay to schedule the payment for a few days before the deadline, giving a buffer for any technical issues. I save the confirmation number and record the payment in my spreadsheet. The entire process takes about 30 minutes. It's routine now, not stressful. A lot of self-employed people worry that paying estimated taxes makes them more likely to be audited. The truth is, it's actually the opposite. Paying accurate estimated taxes shows the IRS you're organized and compliant. What triggers audits is inconsistency, massive year-to-year income fluctuations without explanation, excessive deductions relative to income, or math errors on your return. I've been paying quarterly estimated taxes for 5 years now and have never been audited. As long as you're honest, keep good records, and don't claim obviously fraudulent deductions, your audit risk is very low. The overall audit rate for individuals is less than 1%. Paying quarterly taxes responsibly actually reduces scrutiny. After years of talking with other freelancers and self-employed people, I've noticed the same mistakes repeatedly. First, not paying at all and hoping it'll be fine. It won't. Second, using last year's numbers without adjusting for income changes. Third, forgetting about self-employment tax and only calculating income tax. Fourth, missing the separate state estimated tax requirements. Fifth, not keeping payment confirmations and having no proof of payment later. Sixth, waiting until the last minute and missing deadlines due to technical issues or bank delays. And seventh, treating estimated tax money as available spending money instead of setting it aside immediately. Avoiding these 7 mistakes puts you ahead of most beginners. Understanding why quarterly estimated taxes exist helped me accept them. The federal government operates on a pay-as-you-go system because it needs continuous cash flow to function. Social Security, Medicare, military operations, infrastructure, all require steady funding. Employees provide that through paycheck withholding. Without estimated taxes, self-employed people would pay nothing all year, creating massive revenue gaps. The system ensures everyone contributes throughout the year proportionally to their income. It's not a punishment or targeting of self-employed people. It's equalizing the playing field so employees and self-employed people both pay as they earn. Once I understood this logic, it felt less like a burden and more like civic participation. Here's my final perspective after years of paying quarterly estimated taxes. It's the price of freedom. Self-employment comes with incredible benefits: flexibility, autonomy, unlimited income potential, control over your schedule. Managing your own taxes is part of that package. Yes, it requires discipline and organization. Yes, it's more complex than having an employer handle everything. But it's also empowering. You understand exactly where your money goes. You control your deductions. You make strategic decisions that employees can't. The quarterly tax system felt like a punishment when I didn't understand it. Now it feels like a responsibility I'm capable of handling. That shift in perspective made all the difference. If you're new to estimated taxes, here's your action plan. Step 1. Determine if you actually need to pay quarterly taxes. Will you owe more than $1,000 after withholding? If yes, proceed. Step 2. Download Form 1040-ES from the IRS website and work through the worksheet. Even if you don't mail it, the calculation is valuable. Step 3. Set up a separate savings account for tax money. Label it clearly. Step 4. Every time you receive income, immediately transfer 25 to 35% into that tax account. Step 5. Mark the 4 quarterly deadlines in your calendar with reminders 2 weeks before each. Step 6. Make your first payment using IRS Direct Pay and save the confirmation. Once you've mastered the basics, consider these advanced optimizations. First, use the annualized income method if your income is seasonal or lumpy. Second, maximize retirement contributions to reduce taxable income. Third, consider forming an S-Corp if your income exceeds $80,000. It can reduce self-employment tax significantly through salary optimization. Fourth, work with a CPA to identify industry-specific deductions you might be missing. Fifth, coordinate with your spouse's withholding if applicable. Sixth, front-load or back-load payments strategically based on when you actually earn income. These strategies can save thousands annually. They're not for beginners, but they're worth exploring once you're comfortable with the fundamentals. Let me share the specific resources I use and recommend. For calculations, the IRS Tax Withholding Estimator on irs.gov is surprisingly helpful for estimated taxes too. For tracking, QuickBooks Self-Employed or FreshBooks are both excellent. For payments, IRS Direct Pay at irs.gov/payments is free and reliable. For education, IRS Publication 505 explains estimated taxes in detail. It's dense but comprehensive. For community support, online forums like the Freelancer Reddit or self-employed Facebook groups offer peer advice. For professional help, the National Association of Enrolled Agents can help you find qualified tax professionals. And for state taxes, your state's Department of Revenue website will have state-specific guidance. Bookmark these resources. They are invaluable. Here's what nobody tells you. Mastering quarterly estimated taxes builds confidence that extends beyond finances. When I finally understood the system, made my payments on time, and filed my annual return without surprises or penalties, something shifted. I felt competent, capable, like a real business owner, not someone playing at self-employment. That confidence spilled into client negotiations, pricing decisions, and long-term planning. Managing my own taxes proved I could handle the administrative side of self-employment, not just the creative or technical work. It's a rite of passage. The learning curve is steep, but reaching the other side feels genuinely empowering. You'll get there too. If I could go back to that moment when I opened the $800 penalty letter, here's what I'd tell myself. This isn't a crisis, it's education. You're not stupid for not knowing about quarterly taxes. The system is genuinely complex and poorly explained. Start immediately. Download Form 1040-ES, work through it slowly, and set up that separate savings account today. Don't wait for the next quarter. Set aside money now. Mark those 4 deadlines in permanent ink. And most importantly, know that this gets easier. Within a year, it'll be routine. Within 2 years, you'll help other people understand it. That penalty is the cost of your education. Learn from it, systematize around it, and move forward with confidence. You now know everything I wish someone had explained to me before that first penalty. You understand who needs to pay, when to pay, how to calculate your payments, and how to protect yourself with safe harbor rules. You know about self-employment tax, Form 1040-ES, payment methods, and common mistakes to avoid. You have an action plan, resources, and realistic expectations about the learning curve. Quarterly estimated taxes don't have to be scary or mysterious. They're a system, and like any system, you can learn it, master it, and make it routine. Start today. Download that form. Open that savings account. Mark those deadlines. Take control of this aspect of your self-employment. Future you will thank present you for taking this seriously. You've got this. Understanding quarterly estimated taxes transformed my relationship with self-employment. What once felt like a confusing, punishing system now feels manageable and even empowering. I hope this guide does the same for you. Remember, the IRS isn't trying to trick you. They just expect you to pay throughout the year like employees do. Set up your systems, use the safe harbor rule for protection, track your income religiously, and make those 4 payments on time. If you're still feeling overwhelmed, hire a professional. There's no shame in getting help. The investment pays for itself in saved time, reduced stress, and optimized tax strategy. Thank you for watching. If this helped you, please share it with another self-employed person who might be struggling. We are all figuring this out together.